about buying your very first house? Stay tuned and I'll go through some steps that you can do to help get you there. My name is Napierala with Keller Williams Atlanta Partners. It's time to kick that landlord to the curb and get out of that rent-paying rut. The first thing you can do is stop spending. You got to go on what I call financial holdback. Financial holdback means you don't spend money on anything that you absolutely positively don't have to have. And yes, this can be a little painful. You got to pay rent, you got to put gas in your car, but don't make any big purchases, and whatever you do, don't apply for any new credit cards. If you have debt, pay it off. If you can't pay it off, pay it down. The interest rate that you get is going to depend on your FICO score. Remember, your FICO score will help determine your interest rate. The higher your FICO score, the lower your rate. The lower your debt, the higher your FICO score. Think about what you can afford. Are you doing this on one income or two? While lenders' requirements vary, for the most part, they want your mortgage payment to be at or around 28% of your total monthly take-home pay. They like to keep your debt-to-income ratio at or around 40%. You'll need to choose a lender, and heaven knows there are a lot of them out there. So do your research. Hop online, check out some websites, go see the mortgage person at your local bank. Choose the lender that's right for you. Once you've chosen your lender, go ahead and get pre-approved, not pre-qualified. You often hear pre-qualified and pre-approved used interchangeably, but they are different. To be pre-qualified means that somebody has merely pulled your credit report and seen that you pay your bills on time. To be pre-approved means they have actually pulled paperwork. They have looked at your bank statements, they have looked at your pay stubs. They may even send your information to an underwriter. Once you are pre-approved, you will be in a much stronger negotiating position when you do find that house on which you'd like to make an offer. Next, you'll need to decide what kind of loan you want to get, and your lender will help you decide the one that's best for you. A conventional loan usually has lower rates and fees, but the down payment requirements can be higher. And you must have at least 20% to avoid paying PMI, or private mortgage insurance. Mortgage insurance protects the lender, not you. FHA loans only require 3.5% down, but the rates and fees can be a little bit higher than those on a conventional loan. FHA loans also require mortgage insurance, but it's a little bit less costly than a conventional loan. If you qualify for a VA loan, thank you for your service. Your VA loan requires no money down. It does have a funding fee unless you are disabled. If you are disabled, they waive the funding fee. Remember, if you're using your VA entitlement, the house you choose must be in good shape. You cannot buy a fixer-upper. USDA loans also require no money down. They are for lower income families and you do have to qualify. Homes purchased with a USDA loan are usually in rural areas. Some are in suburbs, but mostly rural. Think about what the right home for you is going to be. Are you worried about the schools? Do you want a home on land? Do you want a home in a swim tennis community? Do you hate yard work and want a townhome or a condo? Townhomes and condos have association fees that will be due monthly, in addition to your mortgage payment. Also, if you use an FHA loan to buy a condo, the condo association has to be approved, and that doesn't happen often. Okay, so now most of the hard work is done. You've chosen your lender, decided on your loan, and thought about what kind of house it is you want to buy. Now it's time to choose your realtor. If you're in the Northeast Atlanta suburbs, that would be me. I am here and I am ready to help. If you found this video helpful, please like, subscribe, and comment.